Hey everyone, ready to chase down your dream home but not quite sure where to start? Don't worry, it's easier than you might think, but there are still some key mistakes you'll want to dodge. Welcome to the Fairway Heartland YouTube channel. I'm Chase Lage with Fairway Independent Mortgage Corporation, part of the Heartland branch. We're here to help streamline your home buying process with our expertise in mortgage lending, supported by over 100 years of combined real estate experience. Our channel is designed for both newcomers and seasoned homebuyers, ensuring you make the wisest financial decisions when it comes to real estate. Check out our videos for more golden nuggets of advice, and if they help you out, hit that like button and share them so others can benefit too. Today, we're tackling the tricky issues that first-time homebuyers often face. I'll guide you through common pitfalls and show you how to avoid them, turning potential headaches into exciting milestones on your journey to home ownership. That's how it's supposed to be, right? Let's get started and pave the way for you to move from being a perpetual renter to celebrating as a happy homeowner. Let's get started with mistake number 1, not getting pre-approved. Imagine finding the perfect home only to discover you can't afford it, or worse, losing it to someone who is already pre-approved. That's why getting a mortgage pre-approval is not just a box to check. It's your first real step towards home ownership. It solidifies your budget, enhances your credibility, and sharpens your competitive edge in a crowded market. Now let's decode some of the jargon. Pre-qualification versus pre-approval. Think of pre-qualification as your financial first glance, based mostly on your feedback about your finances and not binding. It's like telling someone you can run fast based on your own assessment rather than a timed race. A pre-approval is a process. It involves submitting actual proof of income, debts, assets, and having your credit score checked. Your lender scrutinizes these details to decide exactly how much they're willing to lend you. They'll hand you a pre-approval letter, which is your golden ticket when making offers on homes. Here's what these letters might look like. Notice how the pre-approval letter is more detailed, showing a commitment from the lender. This letter tells everyone in the home buying chain that you're not just ready, but also capable of purchasing a home. Using this pre-approval letter, you can negotiate better, enter bidding wars with confidence, and close deals faster. It's a sign to the seller that you're serious and not just window shopping. Plus, it helps you stay focused on homes that you can afford, saving you time and heartache. So before you get attached to that charming Victorian or modern loft, secure your pre-approval. It could make the difference between a bid that's taken seriously and one that's overlooked. Mistake number 2, maxing out your pre-approval payment. It's tempting to aim for the dream house that stretches your budget, but this can lead to financial stress. Just because your mortgage approval says you can buy a $400,000 home does not mean you should buy a $400,000 home. Imagine this, you're approved for $350,000, but instead of going that high, you opt for a $300,000 home. This decision could give you financial flexibility around $300 to $500 a month in monthly mortgage payment. That's money that could go towards savings, emergency fund, a vacation. Always aim for a mortgage that allows you to live comfortably today while planning for tomorrow. That's budget management. Mistake number 3, overlooking additional expenses. There are some potential hidden home ownership costs that come with buying a home. Understanding all the costs involved is crucial to avoid surprises and financial strain down the line. When you think about buying a house, the first cost that likely comes to mind is the down payment and closing fees. But that's just the beginning. One major consideration is the cost of home maintenance and repairs. Many first-time homebuyers overlook these expenses and find themselves unprepared for routine upkeep or sudden issues. Imagine a scenario where your heating system breaks in the middle of winter and you're facing $4,000 in repairs. Such unexpected costs can disrupt your financial stability. When budgeting for a home, a rule of thumb is to save 1% to 3% of your home's purchase price each year for maintenance and repairs. This fund can cover anything from a leaky faucet, a broken appliance, or all the way to replacing your roof. This proactive approach helps you manage unforeseen expenses and also helps in maintaining your home's value over time. Lastly, when you become a new homeowner, it's important to consider the costs of essential tools and equipment necessary for maintaining your property. You'll likely need to acquire several items that you may not have previously owned, such as a lawnmower, a snowblower, or various tools such as trimmers, ladders, handyman items. Preparing a budget for these tools will help ensure that you can handle the regular upkeep of your home, garden, and other areas. Mistake number 4, skipping the home inspection. One major mistake that can end up costing you a lot is skipping the home inspection. You might be tempted to waive this step, especially in a competitive market. But understand this, a home inspection is crucial. It's your safeguard against buying a property with hidden issues that could cost you tens of thousands of dollars. During an inspection, a professional examines the property's structure, systems, and more, looking for any signs of problems like structural damage, old plumbing, electrical faults. This not only protects your investment, but also gives you leverage to negotiate repairs and/or better terms before finalizing the purchase. Mistake number 5, hiding important information. Let's discuss the importance of full disclosure during your mortgage application. Hiding information or tweaking the truth on your mortgage application is not only risky, it's potentially fraudulent. Let's say you omit some of your debts or inflate your income. If discovered, this not only leads to loan denial risks, but may involve legal repercussions. Always provide complete and accurate mortgage application information. Transparency ensures a smoother process, builds trust, and helps overall. After getting a mortgage is not just a transaction, it's the beginning of a major financial commitment. And speaking of financial commitments, this leads me to another mistake. Mistake number 6, making large purchases during the mortgage process. It's crucial to maintain a stable financial profile during the mortgage process. When you apply for a mortgage, lenders look closely at 2 key financial metrics, your credit score and your debt-to-income ratio. In some cases, these aren't just checked once, they are reevaluated just before finalizing the loan to ensure there have been no significant changes in your financial status. Let's break down these terms. Your credit score is a numerical expression based on an analysis of your credit files, representing the creditworthiness of an individual. Lenders use it to assess the likelihood that you pay back your debts. Your debt-to-income ratio is the percentage of your gross monthly income before tax that goes towards paying your monthly debt payments and is a crucial factor in determining your borrowing capacity. Making large purchases or taking out new significant debts can alter these figures dramatically. For instance, financing a new car adds a monthly payment obligation to your finances. If this new debt pushes your debt to income beyond the threshold your lender considers safe, it could signal that you might struggle to maintain your additional debt. Changes to your financial profile can cause delays in your loan approval. Even if you previously qualified, changes in your financial situation could lead to a reevaluation of your application. It can also cause changes in loan terms, as higher perceived risk may lead the lender to offer you a higher interest rate or less favorable terms than what was originally offered. And lastly, changes to your financial profile can lead to outright denial of your mortgage application, as the lender might conclude that your financial situation has become too risky. It's wise to hold off on large purchases until after you've closed on your home loan. Patience during this critical period can ensure that nothing interferes with your mortgage process. If an unexpected large expense is absolutely necessary, it's imperative that you discuss it with your lender to understand the potential impacts on your mortgage application. Mistake number 7, not shopping for homeowners insurance. Homeowners insurance is a requirement of every mortgage lender and typically a part of your mortgage payment. Comparing just 3 different insurance quotes, you could save hundreds of dollars each year. Homeowners insurance covers everything from damage to theft, and having the right policy is like having a safety net for your biggest investment. Don't just accept the first quote you receive. By comparing 3 different insurance quotes, you could save hundreds of dollars each year. Use online comparison tools, check customer reviews, and understand what each policy covers. This isn't just about finding the cheapest insurance rates. It's about finding the right agent and the best value that offers comprehensive coverage for your new home. Mistake number 8, lack of urgency. All right, you've hit the jackpot, found the perfect house, nailed the price, the ink is drying on the purchase contract. Now strap in because you're about to start a sprint against time. That contract you just signed, it's got a close date on it. That's the day when you'll finalize everything and get those keys in hand. But hold up, it's not just a waiting game. Your mortgage lender has a laundry list of tasks to tick off to get your loan squared away within the tight timeline. Expect a few curveballs like requests for more paperwork or some extra details. Yep, your lender might reach out needing more info, and how you handle these requests can really make or break the pace of your mortgage process. Quick tip, keep your phone handy and your email notifications on. Being Johnny on the spot with your responsiveness not only keeps your stress levels in check, but also keeps those last minute panic-inducing scrambles to a minimum. So rally your organizational skills and aim to be the MVP of prompt replies. Keeping ahead of the game helps ensure a smooth ride to closing day. Let's make this process as painless as possible and get you into your new home on schedule. Mistake number 9, documenting and verifying your assets. Look, we all have the best intentions to save money. Maybe we start to pull $100 cash out every paycheck and put it in a safe. Or maybe we transfer some money around to cover some bills or unexpected expenditures. We transfer from our savings to our checking to a different account and a different bank, and then deposit it back in the savings in the form of cash. All of this seems harmless, right? I mean, after all, I'm trying to save money for my down payment and closing costs. Not quite. Mortgage lenders are required to source and season funds used in mortgage transactions. Cash is a 4-letter word in the mortgage industry. If you are saving cash, put it in a savings account and leave it there. This is known as seasoning. You can continue to deposit into your savings account, but do it in the form of electronic transfer. This allows your lender to see the original source of the funds, such as your payroll or disability deposits. The electronic transfer can trace your money from checkings to savings. Also, some home buyers will use a gift for down payment and closing fees. The process of transferring gifts is very specific and dependent on the program. Do not try to transfer gift funds before you talk to your lender. I repeat, do not accept gift funds before you talk to your lender. This could result in countless errors and translate to a process that is not smooth and have negative implications for your approval. Mistake 10, quitting or changing jobs during the mortgage process. Job stability is key when lenders assess your loan application, and changing jobs can be a big red flag. Here's why. Lenders look for a steady and stable employment history to ensure you have a reliable income to meet your mortgage payments. Imagine you're in the middle of securing your loan and you decide to switch careers or jump into a new industry. This move could pause or even reset the evaluation of your loan application as lenders reassess your financial stability and the income with your new job. For example, let's say you're a teacher moving into a sales position, which might offer higher potential income but has a more variable structure. Your lender might view this as increased financial risk, leading to delays in your loan approval, or worse, denial of your mortgage application. If you absolutely must change jobs for any reason during this time, make sure it's in the same field or comes with a significantly higher, stable salary. Even then, communicate this change immediately with your lender to discuss the implications. Now, if changing your job is risky, quitting or losing your job is disastrous, your income is the primary factor when determining your ability to repay your mortgage. When there is no source of income, there is no means of repayment. If, for any reason, you leave your position or are terminated from your role, you should immediately inform your lender. Even if you intend to silently find another job, it will eventually be discovered, as every mortgage process includes a verification of employment a few days prior to closing. It's essential that your employer validates that you are still currently employed. The best advice? If possible, stay in your current job or occupation until after the closing date on your home. Job stability equals reliability in the eyes of the lender, ensuring your path to home ownership is as smooth as possible. That rounds out our 10 biggest mistakes of buying your first home. I promise you, this is not an all-inclusive list. Trust me, I've seen a lot of people wish they had a do-over. If you can avoid these 10 mistakes and ask a lot of questions, I can almost guarantee you that your home buying experience will be exceptional. To ensure you have a great home buying experience, you need to work with a mortgage professional. Check out www.fairwayheartland.com to visit with one of our licensed mortgage loan professionals. We aim to provide a 5-star experience through educating and empowering our clients. If you found this video or any of our other videos, please subscribe, share it with your family and friends who can also benefit from this information.